There are a lot of ETFs out there that you could buy, but ETFs that track the NASDAQ, the S&P 500, or the total US stock market are definitely three of the best options that you could choose. And so in this video, we're gonna take a look at these three ETFs and compare them in each and every category so that we can see which one would actually be the better buy. Now, for those that are not familiar, QQQ is the largest index fund that tracks the NASDAQ, SPY is the largest index fund that tracks the S&P 500, and VTI is one of the largest ETFs that tracks the total US stock market. And so each of these different ETFs have different advantages and disadvantages because they track different segments of the stock market, and they have different dividend yields, they have different expense ratios, as well as different potential gains or losses. So we're going to take a look at each category for each of these ETFs and compare them. Now let's take a closer look at what is actually held within each of these different ETFs. So when it comes to the QQQ, it tracks the NASDAQ 100 index. So this is the most concentrated ETF of any of these three because it only invests in about 100 companies, and it's heavily focused on the tech sector, as you'll see, and it's excluding the financial sector. So yes, as you can see here, there are 101 stocks held within this ETF, and if we look at the top 10 holdings, you will see many familiar names, including Apple, Microsoft, Amazon, Nvidia, Meta/Facebook, etc. So these are all of the largest tech companies in the US. But if we hit on the See All Holdings tab, you'll see it's not all tech companies. For example, you got Pepsi in there, you have Costco, but you won't find banks on this list. And all of the heaviest allocations are to the tech sector. So as we'll discuss in a minute when we look at the actual performance of these ETFs, that leads to higher risk and also higher reward. Now, if we take a look at the SPY ETF, this tracks the S&P 500 index, so about 500 different companies as opposed to 100 different companies. So we'll hit on the holdings tab here and see what we got. You will notice a lot of overlap. So we got a lot of the same tech companies in here because they're the largest companies in the US. However, you will also find other companies on this ETF that you won't find on QQQ. So for example, there's a healthy 12.81% allocation here to the financial sector. And in general, the S&P 500 is a more broadly diversified basket of companies that cover many different industries and sectors. But still, the S&P 500 is a pretty heavily concentrated ETF focused on the 500 more or less largest companies in the US, and it excludes a lot of other companies that you will find in VTI, which is the total US stock market. So this is the most broadly diversified of the three options that we're looking at right here. And if we look at portfolio composition, you'll see here that the number of stocks held within this ETF is 3,793. So for the price of one share, about $220, you are buying fractional ownership of almost 4,000 different companies. And these companies cover the entire range of small to medium-sized to large companies, although the median market cap is still over 125 billion. And again, if we look at the list of the largest holdings, you'll notice a lot of overlap still with QQQ and the SPY ETF in terms of the top tech companies, but you'll notice also that the percentage allocation to these is much lower than in the other ETFs, and there are many, many other holdings as well. And this VTI ETF is trying to recreate essentially a cross-section of the entire US stock market. So with that additional diversification, it reduces your risk because you're invested in over 3,700 companies. However, as we'll see in a minute or two, it does cap your potential gains relative to what you could get if, for example, the QQQ 100 does very well. Let's take a look at the actual prices of the ETF shares. Now, this isn't super important, although I will say that unless you have a brokerage firm that allows you to buy fractional shares, an ETF that has a lower average price will just make it easier for you to dollar cost average into that position over time. Now, the QQQ, as of the time of this recording, has a price per share of about $390 US. SPY, which tracks the S&P 500, has a price of $455, and VTI has a price of $225. So assuming everything else is equal, it would be easier to dollar cost average into the VTI or the Vanguard Total Stock Market Index Fund. All right, next, let's take a look at total assets under management. Essentially, what is the market cap of the index fund? The total value of all of the shares combined. So for the QQQ ETF, the market cap is 152 billion. For SPY, it's 410 billion, and for VTI, it's 184 billion. So SPY is far and away the largest ETF of these three in terms of total size or market cap. Although each one of these is absolutely massive, all of them have over $150 billion in market cap. And what that means in a sense is that there's some kind of safety in numbers, because massive market cap like this usually equates to liquidity. But let's take a look now at actual trading volume of these. Now, the reason why trading volume or liquidity is important is because it's a measure of whether or not you will be able to buy and sell shares when you want to. And if we take a look at all of these ETFs, the QQQ ETF is frequently one of the most traded stocks on the stock market. It moves millions of shares per day, and so no issue there. If we look at SPY, it is even more frequently traded. It has a higher average volume and it moves millions of shares per day. And if we look at Vanguard's total stock market index fund, it has definitely lower volume. However, its average volume is still millions of shares per day. And so for each of these ETFs, while there's definitely differences, I would say that the market cap and the average volume and liquidity are all very safe, so you don't have to worry about that. All right, the next important thing to take a look at when we're comparing different ETFs is the expense ratio, which is the percentage of the investment that the fund managers are going to take in exchange for managing and balancing the ETF portfolio. So let's start with QQQ. You can see that the expense ratio here is 0.2%, which is actually a little bit on the higher side, because if we take a look at SPY, the gross expense ratio is just under 0.1%. So it's less than half of the expense ratio of QQQ. Now, 0.1% is not exactly a lot, but if you're investing a lot of money over time, that does add up. So it's definitely important to consider. And if we compare that to VTI, this has an incredibly low expense ratio of 0.03%. So it's a tiny fraction of the expense ratio of QQQ. All right, next let's take a look at the dividend yield for each of these ETFs, because every time the companies held within the ETF pay out dividends to shareholders, the ETF will pass a portion of those, most of that, on to the shareholders of the ETF. So let's start with QQQ, and the 30-day average yield is about 0.7%. So not a lot, and that's to be expected because the types of companies held within the QQQ ETF on average pay out much fewer dividends than some of the companies held within, for example, VTI. Next up is the SPY ETF, and the 30-day average yield of this one is 1.4%, give or take. So that's actually double the average yield of the QQQ ETF. And then finally, looking at the VTI, we've got an average 30-day yield of almost 1.6%. So this one has the highest dividend yield and the lowest expense ratio. Now, with those basic characteristics of these ETFs out of the way, we can now take a look at the historical performance and expected future returns, because let's be honest, that's what we care about. Now, it's important to note here that past performance is definitely not a guarantee of future performance, but there's also definitely different risk profiles for each of these ETFs, as you'll see. So let's actually start with VTI and then move to SPY and finally QQQ, because VTI is the lowest risk, but also potentially the lowest reward, because your investment is spread out over almost 4,000 different companies. One of those companies doing really, really well isn't going to have as much of an impact as it would if you only had invested in 100 companies. So let's take a look at the historical performance of the VTI ETF. You can see that since inception, this ETF is up almost 300%, and apart from a couple of dips in the 2008-2009 financial crisis, and then during the pandemic, there's a steady uptrend with this ETF because it's just tracking the growth of the total US stock market, which over time traditionally has been one of the best performing investments you can make globally. Now, if we go over here to the ETF page, we can take a look at the actual average returns here. So since inception, this ETF has returned an average of 7.66% per year. Although over the last 5 and 10 years, it's returned an average of over 10% per year. So that is a very solid return, especially considering the fact that your expense ratio is super low. You've got the best dividend yield of these 3 ETFs, and you are very, very diversified. So there's less risk. Next up is SPY, and you can see that since inception, this ETF is up almost 950%, so significantly more than VTI. And this is a concentrated bet on the 500 largest companies in the US. So this is already showing us that increasing concentration can increase gains if those companies do well, which over the past few decades, they certainly have. Now this ETF will have steeper drawdowns than VTI. So for example, it was down 50% in the financial crisis of 08-09. Now if we look at the average returns since inception, the SPY ETF has yielded an average of 9.62%. And over the last 10 years, that's been over 11. Over the last 5 years, it's been over 10. And actually, interesting to note that over the last 5 years, the return of SPY has actually been quite similar to the return of VTI. Now, what about QQQ? Well, let's go back over here and check it out. Since inception, this ETF is up 634%. However, since 2003, this ETF is up over 1,800%. And you can see that the rate of increase of QQQ is much steeper than the rate of increase of SPY or VTI. Now, if we go to the fact sheet over here and take a look, we can see that since inception, the average annual return of this ETF has been just under 9%. However, if we look at the 10-year average performance, as we saw in the steepness of the chart of the stock price, the QQQ ETF is returning an average of over 17%. And even over the last 5 years, is returning an average of almost 15%. So over the last couple of decades, QQQ has significantly outperformed SPY and of course VTI. And year to date, this ETF is up over 35%, which is absolutely insane. All right, so now we have a pretty holistic picture of what's included in each of these ETFs, how much it costs to invest in them, what they pay out in dividend yields, and what the historical returns have been. So which one of these is actually the better purchase? Well, honestly, it depends on what you are trying to achieve. Because if you have a higher risk tolerance, then it's possible you might want to invest in QQQ over VTI. However, if you're getting closer to retirement, or if you just aren't interested in seeing large swings in the average price of your investments, then maybe VTI is a better bet because it's more of a steady, stable return. As you increase the concentration of your investment, especially in companies that have been doing very well recently, for example, a lot of the tech companies held within the QQQ ETF, then you are increasing your potential returns. But of course, there's that downside you have to worry about where you can get a very steep drop off in a very short period of time. Now, if I was forced to pick only one single ETF to invest in, I would probably choose VTI just because it has more stable returns and more diversification. So yes, hopefully you found this video helpful, and depending on your risk tolerance and where you're at in life with relation to your financial goals, these different ETFs could make sense at different times of your life. Thanks so much for watching, and if you enjoyed this video, you might also like this one right here. See you later.